In 1913, something happened in the United States that almost nobody at the time considered revolutionary. There were no riots, no tanks in the streets, no dramatic overthrow of government, just two pieces of legislation. What? And yet, if you trace nearly every major economic shift of the last century, debt explosions, inflation cycles, world wars, corporate bailouts, wealth inequality, they all passed through that year. So here's the uncomfortable question. What if 1913 quietly redesigned the American economic system? Before you jump to conclusions, let's rewind. For most of the 19th century, the US federal government did not operate on income taxes. It funded itself primarily through tariffs, excise taxes, and land sales. The idea of directly taxing individual wages was politically toxic. The framers of the Constitution had deep suspicion of centralized taxation power. Article I restricted direct federal taxes unless apportioned by state population, a complicated mechanism that made income taxation nearly impossible at scale. Why? Because they had just fought a war against a monarchy that extracted wealth without representation. The early American system leaned toward limited federal power and decentralized finance. But by the late 1800s, America had changed. Industrialization exploded. Railroads spanned the continent. Oil, steel, and banking empires emerged. And with them came the era of men like John D. Rockefeller, Andrew Carnegie, and J.P. Morgan. The wealth gap widened dramatically. Public resentment grew. Populists and progressives argued that tariffs disproportionately hurt the working class because they raised consumer prices, while industrial magnates accumulated massive fortunes, so the political momentum shifted. The pitch was simple. Income tax would target only the wealthy. Ordinary workers would be untouched. The burden would shift upward. That was the messaging. In February 1913, the 16th Amendment was ratified, granting Congress the power to tax incomes without apportionment among the states. Initially, it barely affected anyone. The Revenue Act of 1913 set exemption thresholds so high that fewer than 1% of Americans paid the tax. Is the top marginal rate just 7%? Hardly revolutionary. But here's where people oversimplify history. The income tax alone didn't change everything. What mattered was what happened later that same year. In December 1913, Congress passed the Federal Reserve Act, creating the modern central banking system, the Federal Reserve. Now pause. This is where conspiracy narratives usually take over. Let's be precise. The Federal Reserve was not created as a cartoon villain. It emerged after repeated banking panics, especially the Panic of 1907, exposed how unstable the decentralized banking system had become. Private banks failed, liquidity froze, credit evaporated, economy nearly collapsed. Leaders like Woodrow Wilson supported a central bank to stabilize the financial system by acting as lender of last resort. That was the stated goal, but here's the structural shift. Once you create a central bank capable of expanding the money supply, and a federal income tax capable of generating scalable revenue, you have fundamentally altered the government's fiscal capacity. Before 1913, federal spending was constrained by tariff revenue and hard money limitations. After 1913, the constraints weakened. And then came World War I. War as the ultimate accelerant of state power. Between 1916 and 1918, income tax rates surged. The top marginal rate jumped to 77%. The tax base expanded rapidly. What had been marketed as a narrow tax on elites widened under emergency funding needs. This is not conspiracy. It's a historical pattern. Crisis expands government authority. After the war, rates fell, but the system remained. Then came the Great Depression. Under Franklin D. Roosevelt, top marginal rates eventually climbed as high as 94% during World War II. But here, something most dramatic narratives ignore. Very few people actually paid 94% on their entire income. That was a marginal rate on income above extremely high thresholds. The bigger structural shift wasn't the top rate, it was the expansion of the tax base. Before World War II, only a small fraction of Americans paid federal income tax. By 1945, tens of millions did. The key innovation wasn't just higher taxes, it was payroll withholding. Instead of asking citizens to write one painful annual check, the government required employers to deduct taxes directly from wages. Behaviorally, that changed everything. People adjust to net income. They rarely see gross income. This dramatically reduced tax resistance. Now let's address the monetary side. A central bank does not print money in the simplistic way it's often described. It expands reserves, influences interest rates, and conducts open market operations. But yes, fiat currency systems allow governments more borrowing flexibility than gold-constrained systems. And borrowing changed the scale of government. World War, the First World War II, the Cold War, Vietnam, the War on Terror. Deficit spending became normal. National debt grew, especially after the gold standard ended in 1971 under Richard Nixon. That was another pivotal shift. The dollar became fully fiat. From that moment, monetary expansion was limited primarily by inflation risk, not gold reserves. Now let's challenge the dramatic claim that income tax exists solely to service central bank debt. That's not structurally accurate. Income tax funds a massive range of expenditures: defense, social security, healthcare programs, infrastructure, education, and interest payments. However, here says the uncomfortable truth. Once a government has both scalable taxation and elastic currency, its potential size expands dramatically. That is not ideological, that's arithmetic. Now let's examine inequality. Did the system trap the middle class? Not exactly. Post-World War II America saw massive middle-class expansion, suburbanization, home ownership, industrial growth. But starting in the 1970s, something changed. Wage growth slowed. Asset prices accelerated. Financialization intensified. Here's where the Cantillon effect, first described by Richard Cantillon, becomes relevant. New money enters the economy unevenly. Those closest to credit markets and financial assets benefit first. If monetary expansion boosts stock markets and real estate faster than wages, asset holders gain disproportionately. Yeah, that's observable data, not theory. Combine that with tax structure. The U.S. taxes labor income more heavily than long-term capital gains. That creates a structural asymmetry. Wealthy individuals often hold appreciating assets. Middle-class individuals primarily earn wages. Add strategies like borrowing against appreciated stock used by ultra-wealthy founders, and you get deferral advantages within legal frameworks. That's not secret. It's tax code design. But here's where we need to stay honest. The system did not destroy America. It built the largest economy in human history, financed global wars that reshaped geopolitics, funded interstate highways, it enabled technological revolutions. At the same time, it enabled chronic debt expansion. As of today, U.S. national debt exceeds $36 trillion. Interest payments are one of the largest federal expenditures. That is mathematically significant. Can it continue indefinitely? Only if growth exceeds borrowing costs, inflation remains manageable, and investor confidence holds. If those fail, adjustment becomes painful. Let's address the